Mortgage interest rates keep rising. So why do home prices also keep going up? That's the question on everyone's mind, and that's what I'm going to discuss today with the CEO and president of BiggerPockets, Scott Trench. BiggerPockets is a real estate investing community with more than 2 million members. And Scott Trench, its CEO and president, he and I get together to talk about the question that's on everybody's mind, which is why are home prices continuing to rise? Mortgage rates currently are at the highest point that they've been since the year 2000, and home buying is at the lowest point it's been since 1995. Given that homes are more expensive, given that fewer people are buying homes, why is there so much resiliency in the real estate market? More so than a lot of armchair commentators had initially believed, right? The short answer is supply and demand, but Scott and I go deep into the data behind that answer. We discuss regional market dynamics because, of course, the real estate market is not a monolith. And what's happening in the Sun Belt is different from what's happening in the Midwest versus the Northeast. So we talk about regional market dynamics, and we talk about also not just where we are presently, but what's going to happen in the future. What are the trends that we're seeing with relation to migration, demand, new home construction in both single family and multifamily, and how that separates regionally. We discuss all of that. We talk about the recent resurgence in the popularity of syndications and syndicated deals. And we talk about how to think through investing in different markets. So we cover a lot of ground in this upcoming interview. Enjoy. This is BiggerPockets CEO and president, Scott Trench, to talk about the fact that mortgage rates keep rising, but so do home prices. Why? Let's deeply, deeply understand why. Here we are. So the last time that we spoke, it was a very different real estate market. So much has happened in the last 3 years in real estate. Let's take a snapshot of where we are right now and bust through some of the myths and misconceptions. First of all, we're recording this in August 2023. Can you give us a snapshot of where are we at this moment in real estate?
And I'll break that into a tale of different parts, and we'll focus on the residential real estate market, right? So there's places in the commercial and multifamily space, different world. In the residential space, we're at this kind of point where I think a lot of people are surprised that prices aren't lower, right? When interest rates have doubled, why haven't housing prices come down? The lack of affordability has skyrocketed in the last year. Mortgage payments are 40, 50, 60% more expensive for the same level of house, but prices haven't come down. What gives? That's, I think, the big question right now. And the big part of that story is what we call the lock-in effect. Homeowners around the country locked in 3-4% rate mortgages in the last couple of years, have a lot of equity. Many homes in this country are paid off, and they're stuck. They can't move, because if you have a $700,000 house and you want to upgrade to an $800,000 house, maybe you could have afforded that a year or two ago. Or maybe you want more square footage. Maybe you want to move to a different place. You can't do that now because you're giving up this low locked in mortgage rate, and you're going to have a skyrocketing home payment. So all but the best opportunities, the most dire situations, are eliminated from the transaction market. And so that's leaving a lack of new supply and new inventory coming on, which is keeping prices high. Right.
Well, in addition to that, higher interest rates also mean that it's more expensive for builders to build, which then also contributes to lack of new inventory.
Absolutely. And, I would have thought that builders were going to get crushed this year. That was, I think, where the smart money was at. Boy, is that wrong.
Right.
Home builders have been thriving in this environment because of that lock-in effect. So home builder, like one of my buddies doubled down on building more homes earlier this year, and I was like, oh my gosh, I wouldn't want to be on that side of that bet. And again, boy, was I wrong. This guy is thriving right now. He's putting a bunch of properties on the market. They're not competing with existing property listings.
Right.
And so they're able to kind of set their terms. Sure, they're not selling for as much as they were a year ago, but they're selling for a lot more than they feared they would be at this point in time. And they're still very profitable.
Right. And are we also seeing that the stock prices of Home Depot, publicly traded companies that benefit when a lot of people are renovating their homes, those stock prices have done very well. Has the trend followed? There's been a lot more renovation because of that lock-in effect.
That's a really good question, and I actually don't know the answer to that. I would have been before this call, I would have wondered if Home Depot was actually struggling a little bit this year. And what we found in the real estate community is that a lot of flippers, for example, are reporting that prices for dilapidated properties that need a lot of work have fallen a lot more than properties that don't need a lot of work. Perhaps ironically, because a lot of households don't want to spend the cash to fix up the property. They'd rather just pay more for the property. So there might be something to that effect, but who knows? Those are some different data points there.
Right. Well, I mean, it stands to reason that the interest you would pay on a 203K loan would also be, substantially higher, and that would probably also have an adverse impact on the number of people who renovate.
Yeah, there might just be fear of the unknown in rehabbing the properties, not knowing what to do, not knowing how much it's going to cost, all that kind of stuff. Right.
And I mean, that is always present, but I suppose in 2023, when inflation is so out of control, the question is always why now, right? Fear of the unknown is omnipresent and universal. It's evergreen, but in an inflationary environment, there's added uncertainty.
Absolutely. Speaking
of an inflationary environment, what is happening with home prices?
So that's a pretty interesting phenomena. Our VP of Data and Analytics, Dave Meyer, did a pretty extensive study on 295 housing markets around the country. And what's the story with home prices? It's really hard to make one right now. What is that story? Well, on average, home prices, this is a month or two out of date. So this is end of May report, but prices are down 2% nationwide, but that doesn't really tell the story. 200 out of 295 markets are seeing home price appreciation, but the magnitude of the fall in many of the markets where you're seeing home price depreciation is counterbalancing that to get to that negative 2% growth rate. So markets like Boise, Idaho, for example, have fallen like 20% year over year, but markets like Rochester, New York have seen pretty smooth and steady growth. They almost haven't noticed the interest rate rising environment at all. So it's a pretty wild situation, and it's kind of, really hard for, I think, investors and homeowners alike to kind of make out what to do in that context.
That's interesting. So year to date, the Case-Shiller index is up, from where we were January 1st. Overall, nationwide, the Case-Shiller index has risen. How is that? How can both be possible? How can the Case-Shiller be high while nationwide you've got -2?
Yeah. So in 2022, prices came down towards the end of the year, right? They came up at the beginning of the year in that Q1 period before interest rates rose. And then prices began falling. So year over year, starting in May.
Got it.
That's when you're starting to see some of that price decline.
Got it. Yep. Now, Boise is a particularly interesting example because Boise had the shortest number of average days on market of any major metro area in 2022. I actually was just looking this up for an article that I was writing for our newsletter. Boise in 2022 had as little as an average of 8 days on market, which is just phenomenally quick sales. Why have prices fallen? Was it simply that people over speculated in Boise, and so you're having a hyper local effect there?
I think it's going to be really hard, and it's real estate is so regional. Why is Boise doing this? Why is a market in Austin, Texas doing this? What's going on with Charlotte? Right? You can make up a different set of answers for each one of those. Right? I might speculate that Florida, for example, some of the markets there are seeing negative rent growth and negative year over year home price appreciation because of the insurance things you've seen, right? It's almost impossible to get insurance in some places in Florida as a result of that. For Boise, I'm not sure specifically. It seems like a lot of out-of-towners moved there over the last 5, 6, 7 years, and it was one of the hottest markets in the country. And maybe in the last year or two, the appeal of that or the relative spread, the one of the benefits of moving to Boise from Southern California, for example, might have been the much lower cost.
Right.
If that's no longer there, maybe folks are moving back. Maybe there's other dynamics at play in a market like Boise. But I'm not an expert on Boise in particular, so I'm only speculating here.
Right. Yeah, at least anecdotally, a lot of the interest in Boise seemed to be coming from well-compensated knowledge workers migrating from coastal cities, right? Migrating from California. And it created some frothiness in the Boise market for a while. But it goes to highlight how all real estate is local. How whenever people talk about the national real estate market, it's
your headline's 2% down year over year. Again, depending on how you want to look at it, we'll see how it plays out over the course of 2023 versus 2022.
Right.
End of year comparison. But Yeah, it's local, and that story, that 2% national headline, has nothing to do with your reality, right? You ask people around the country, at random, some people are going to say the market's up, some people are going to say it's flat, some people are going to say it's down, and they're all right. Because it's so local.
Because it's so hyper-local. Right. To what do you attribute the 2023 year-to-date rise? Like, why is it that we reversed out of the decline that was happening towards the end of 2022?
Sorry, the 2023 is slightly negative to 2020. The current housing market is slightly negative to last year.
Yeah, year over year, yes. But I'm thinking year-to-date, January 1st through August, right? Overall, nationwide, we've seen some growth. Right? So to what do you attribute that? Like, why has the aggregate market picked up this calendar year?
One dynamic is with interest rates high right now, and typically tending to rise, when they fall briefly, like let's say interest rates are 7.5 and they come down to 7 or 6.9.
Right.
I think a flood of people go in to get pre-qualified for mortgages. That creates a ton of competition in the weeks up after that, after they get pre-approved or lock in those rates.
Right.
And when the rates go back up, that comes out. And so I wonder if you're seeing pulses of pricing around the country in markets that are being impacted by that kind of macro dynamic that's creating pockets of competition. And depending on when you look at the data, you're going to see these increases or decreases. So that's one speculation I've had, because over the course of the year, you've been like, wow, there's nobody buying. And then there's like, oh, I just had a bidding war.
Right.
I think that's a dynamic that's going to happen as interest rates are volatile, but climbing in those little pockets of downturns there. I also think there's just a lot of demand for housing right now. Millennials are trying to move in and get houses.
Right.
A lot of them are moving back to where they grew up and trying to buy those houses, right? A lot of Denver, for example, had net outbound migration the last 2 years. I would never have predicted that a couple of years ago.
Right.
But I understand exactly, right? I'm 32 years old, and a lot of my friends are moving back to Ohio, Maryland, Northeast, because that's where they grew up and that's where they're starting to settle down again.
Right. So we've got a couple of trends happening at the same time. We've got millennials, which is the population of millennials is significantly larger than the population of Gen X or of Gen Z, right? Millennials, as the children of baby boomers, millennials are a particularly large demographic relative to Gen X and Gen Z, right? And millennials are exactly at that age where many become first-time home buyers. So you've got this trend where you have a lot of demand. And we've also known for more than a decade that housing supply is short, right? That we have this shortage. Why is it in most markets or in most spaces, when there is low supply and high demand, the market takes care of that? Why is that not happening in housing? Why do we consistently and predictably have demand that exceeds supply, but we just can't get the supply up there?
Obviously, there's labor supply constraints.
Right.
There's materials supply constraints. But I wonder if in 2023 and 2024, the exact opposite of what you're talking about is going to happen. We have the most new housing units under construction in history, at least where we've been tracking it. We have, I think, 1.6 million units under construction. Now, 900,000 of those are multifamily units. So the multifamily market is going to have a lot of stuff coming on, and that's all happening in the South and the West. But there's another, so what is that, 700,000, whatever the balance is,
right? Single
family homes that are under construction currently. And why is that happening? Well, it's a 2 or 3 year lag to get a development project. Like if you're going to develop tens of thousands of homes, this is not a overnight project. You didn't start that last month. You started it 3, 4, 5 years ago, maybe a decade ago. Same thing with multifamily construction. So I wonder if in the next year or two, we're going to continue to see the pressure of both interest rates and massive supply coming online. But again, to our point earlier, it'll be hyper local. The South and the West are going to see the brunt of that new supply coming online, and the Northeast and the Midwest are not going to see as much supply coming online. So if you're in the Northeast, you might not see prices come down or rents, stabilize. They may continue to grow. But if you're in the Sun Belt, you might see housing prices become much more affordable in the next couple of years.
Wow.
The next 2 years specifically.
Wow.
We'll see.
So your theory then is that it's that supply will catch up with demand. It's just taking some time. essentially.
Yeah, and there's a large body of thought around this. Who knows like the real fundamental answers? A couple of other key points around why supply is constrained. We have what's called the national local problem, which is a kind of an ironic phrase about how most cities, most parts of most cities are zoned for single family only.
Right.
So everyone wants more housing supply, but nobody wants it in their backyard.
Right.
No one wants their single family development to be the one that allows duplexes, triplexes, or quadplexes, much less a 15-story apartment building that blocks their view. Boston, for example, this came up in a forum post in BiggerPockets, 85% of the land in Boston is zoned single family. So in order to even have the opportunity to build, you have to have the right zoning. So that's one factor. I think that, again, we talked about labor supply. We talked about material supply. Another factor is, the labor itself. Not just how do we encourage more people to do this, but housing booms and busts. So I would predict, and this happened in the Great Recession, so I'd predict a similar type of story here where tons of new construction happening in 2004, 2006, 2005, 2006, 2007, no construction starting 2008, 2009, 2010.
Right.
So you have this pool of labor that's highly skilled in construction, and then they exit because they're all getting laid off because there's no more building activity.
Right.
So now you don't have skilled laborers to do these big projects, right? You couldn't even hire them if you wanted to.
Right.
And so I think that's a dynamic that's impacting housing construction costs as well, is the lack of this skilled labor to do it. And so, to really get skilled construction supervisors and leaders, they need to be in business for 10, 15, 20 years. And if the boom and bust cycle of real estate is so cyclical, your floor of labor is not high enough. So those are some theories, for example, that people have around why there's not enough housing.
Right. You've mentioned how most of the development is happening in the Sun Belt, in the South and in the West, right? To what extent is that, that is public knowledge, it's public information. To what extent is that being factored into new developments in the Northeast and in the Midwest, right? Which is another way of saying, are we going to see that shift flip as developers recognize more opportunities in overlooked parts of the country?
I think that the folks who are doing this like to think that they're really smart investors, and they're basing it on migration patterns.
Right.
So part of that is, hey, why are we building so much in Denver and Phoenix? It's because we're expecting more people here. We know there's demand. We believe there's going to be a lot of demand there.
Right.
So I don't know if people have got it right or got it wrong, but if the demand doesn't turn up, you're at more risk in these places where a ton of supply is coming in, right? So I think again, I'll pick on Florida and Texas here, right? Florida has got this insurance problem, lots of natural disasters, right? They're very business friendly, and a lot of people want to move to Florida for the climate, but they've also got offsets around politics, right? That's a draw for some people, and it's not a draw for other people. Same with Texas. And I think that there's a risk in those states that you're overemphasizing the benefits of there and not really factoring in the risks, specifically with, I think insurance is the big one in Florida. I think property taxes are going to be a big one in Texas.
Right.
So.
And you said there was net outflow from Denver for the last couple of years.
It's minor, but a little bit. Yeah.
Minor, yeah. And that's not something that I would have expected from a place like Denver.
Kind of scares you as a real estate investor in Denver because you go look outside and there's 40 cranes, or 15 cranes or whatever it is, all built in multifamily.
Right. The thing about population dynamics is that they change very rapidly because people have mobility and can move quite quickly, especially inside of the United States. I mean, there are no restrictions against interstate movement. So it's very easy to move from Texas to Maine or from Florida to Kansas, right? You don't need a passport. You don't need a visa. You don't need currency exchange, right? You don't need special work papers for one state over another. So given that migration can happen so quickly, and yet there is such a lag time when it comes to real estate development, does that entrench the population patterns that we've seen 5 years ago? I guess that's kind of a complicated way of saying, are developers building based on outdated data because of the necessary lag time?
You're asking great questions that, again, I can only speculate on. So these are only, this is a fun discussion here, but I don't think anyone really knows the answer to these things. If I'm going to speculate, I would say that in the COVID pandemic, lots of people, it was a big reshuffling. There's a lot of fuzzy data, right? So, for example, household formation spiked during COVID. Really? Like, did we really have a lot more households form, or did people, break up? Did they, when a divorced couple breaks up, there's a two net household formation. When roommates separate, there's net new household formation. When someone in New York City, is renting an apartment and they don't want to be in New York City during COVID and they move out to, a house with some land where they can actually get outside and breathe during the pandemic, maybe there's some sort of data manipulation. There's two households or something, two rents that are being paid, two, leases. So there's a big shuffling there. And so that's the big question is, are there going to be enough household formations nationwide? Where are they going to take place? And everybody's placing their bets when they're developing. That's, part of the bet behind it. I also think that with COVID, you had a great reshuffling of labor, right? Instead of having to work in Denver at this job, you now had access to every job that you were qualified for in the entire country.
Right.
So wages skyrocketed for that cohort of workers, white collar workers that could do their work remotely, right? Because why wouldn't you arbitrage that and take the highest check? Now, what's going to happen next? I think, folks have largely probably optimized for that environment. There's always going to be people changing jobs to optimize for that. But that burst of activity, that burst of optimization for a lot of white collar workers, I think is over. And a lot of companies are starting to require you to come back into the office. Requiring someone to come back in the office, if you're the CEO, that there's probably going to be some people who are going to leave and there's going to be a different set of talent in there. I don't know how big of a thing that's going to be. I don't know where that's going to lead, but I can see that forcing people into bad situations, right? I got a remote job, in New York from Denver. CEO now says, I want everybody in here. I have two options. I can look for another job, which is harder now, or I can move to New York and give up my 3% interest rate mortgage and get a more expensive housing environment. So I think those are going to be challenges that people are going to face in the next couple of years. And I don't really know. I haven't thought through it enough to think how that will play out.
Yeah.
In terms of markets.
We interviewed a researcher who's been studying work from home, remote work, since the late 90s, back when it was referred to as telecommuting. And one of the comments that he made in our interview was that he predicted, he was starting to see a trend that he predicted would continue of the outer rings of major metro cities becoming very attractive because a lot of offices will require workers to come in maybe 2 days a week, right? They have a hybrid work environment. And so people need to live close enough to their job that they could commute in, every Monday and Friday, or every Tuesday and Thursday, but they don't necessarily need to be right in the city center anymore.
I think that's a great theory. I haven't thought through that enough, but that makes all sense in the world to me. That's exactly what I did. I live 30 minutes outside of Denver in the pocket of the mountains and go in once a week to the main office. So, and it's a 30-minute drive, but I would not do that every day. If things were different, but that's exactly what I'm doing. So, yeah.
All right. Excellent. But this is all speculation. I mean, so, for the average person who's listening to this, who lives in, we'll say mid-sized city, maybe they live in, Kansas City, right? And they're a knowledge worker, they're thinking about buying their first rental property or their second rental property. They're nervous about home prices, but they're also a little bit overwhelmed by all of this talk about home building and interest rates and all these macro factors. To what extent do they really need to think about this?
Well, I think all investing decisions start with a macro look and then boil down into a very tactical one, right? So if we zoom way out to the macro, I have, as a middle-class American worker trying to get started in investing, I have a couple of broad options available to me. I can invest in the stock market. I can invest in the bond market or debt. I can invest in real estate, and I can try my hand at some alternatives, perhaps like Bitcoin or private businesses or whatever in there. So that if we're agreeing with that premise that that's kind of the broad opportunity set here, how do things rate in relation to one another in terms of opportunities or diversification or whatever I'm looking for? The stock market, we just talked about how the real estate market is down a little bit year over year from a price point. trending up year to date, confusingly. But the stock market is up like what, 15, 17%, something like that year to date. If you exclude the FANGs, I read this, it's down 2%. So, if you exclude like 5 tech companies, essentially the U.S. stock market is down 2% year to date.
That makes sense because Microsoft, Nvidia, basically any company that would profit from AI, has led the charge.
Google, Apple, Microsoft, Tesla. Is Tesla? Yeah, I think Tesla is having a good year, but in the context of a bad 2 or 3 years, something like that.
Yeah, I haven't checked.
Maybe I'm off on that one. But like if you exclude these like 5 select tech companies that are pretty big, market's down. The rest of the market. So, how do you play into that? Interest rates are rising. There's not a lot of reason to believe that the Fed is going to bring them down in the near term. There's a lot of reason to believe they're going to stop raising them.
Right.
But that's not good news. The yield curve is inverted. And so if the Fed doesn't reduce rates, the interest rates on longer term debt are going to keep marching up, which is bad news for the bond market.
Right.
You got real estate, which, hey, what's going on here? Why haven't prices come down more with the interest rate environment? We talked about the intricacies of supply. What's holding back inventory is this lock-in effect. There is a lot of new constructions. That is a risk. And then you have, small businesses, which are a lot of work and maybe inaccessible to a lot of folks.
Right.
So in that context, obviously, I'm a real estate investor and like real estate, I like the fact that I can lock in debt, amortize it over a long time horizon. I'm going to make money through amortization of my debt, some appreciation. I'm going to produce some cash flow. Once I've made that determination, now I pick those markets. Kansas City, I like Kansas City. I think that's a great example of a place where there's potential opportunity in this country. I don't know the supply and demand dynamics. You need to dive into that. Is some of that supply that's getting in the South and the Sun Belt hitting Kansas City, or is that are you pretty insulated from that? But if so, that might be a great place to hold real estate for a number of years, and you can probably get a pretty good cash on cash return. In a market like that in the Midwest.
Right. How do you go about, or how would you recommend a person go about trying to figure out which city they should be investing in, right? But as we discussed at the beginning, at the top of the show, all real estate is local. All real estate is hyper-local. So there is no such thing as a national market. There's only a bajillion mini markets, or a bajillion local markets, right? But for a person who lives in Manhattan, who is definitely not going to invest in Manhattan, they're trying to figure out if they're going to invest in Kansas City or Omaha or Cincinnati. How do they get started?
Yeah, I think I'll again quote our VP of Data Analytics, Dave Meyer. I think he has a good handle on this. But, I think there's 3 ways to think about what you want to go for. Do you want cash flow? Do you want appreciation? Or are you looking for a hybrid? There's nothing that offers everything all at once. Right. But you can get a blend of, if you're to plot out the appreciation and cash flow of the market, it's just a distinct trend line where there's a trade-off. There are bubbles, this is over the last 5 to 10 years. There are bubbles in a couple of markets that have done well with both. But you're really going to have to make a trade-off decision there.
Yeah.
Many investors choose cash flow. I think that's great. But I personally think that, unless you are needing the cash flow in the near term, appreciation is going to net you off in a better place in 5 to 10 years. So you look at those net migration patterns. You look at where the supply is coming online and where it isn't. You look at places that you like to be a part of your life, is you can actually physically go there, visit, meet the people that are going to be renting that are going to be managing your property and helping you find deals. I think those are going to give you distinct advantages. And it's a bet of what's going to happen over the next 10, 15, 20 years, right? As part of that. Dave Meyer has some projections. He's got, here are the best 10 cash flowing markets currently in the country. Here are 10 that might have great appreciation prospects next year. And here are some hybrid markets. So you have to read that and determine if you agree with those, his calls on those ones.
All right. Well, we'll link to that in the show notes.
Absolutely.
Yeah, we'll link to that in the show notes. So what you just outlined, determining if you're going to pursue an appreciation strategy versus a cash flow strategy, makes me think of the analog to that would be essentially growth stocks versus dividend stocks.
You got it.
Right? So, and the trade-off, if you're going for a high dividend portfolio, the trade-off of a stock spits out high dividends because it's not reinvesting in growth.
Absolutely. Now, I'll also answer from a context of what I'm doing personally. I invest in Denver, Colorado. I am not bullish on Denver, Colorado real estate in the next 2 or 3 years, but I'm not doing anything with my portfolio. I'm logged in to that 3%, 4% interest rate mortgages, right? As a landlord, I'm holding those properties. I'm expecting relatively low appreciation compared to the rest of the country. So if the country's negative, I expect Denver to be more negative. If the country's positive, I expect it to be less positive over the next couple of years because of the supply dynamics that I was telling you about. But I also believe that over the next 10 to 15 years, holding on to this great low interest rate debt in my backyard, operating well, I'm going to harvest cash flow and I'm going to amortize my debt. And over 10 to 15 years, I think Denver is as good a bet as any other market in the country because of the fundamental reasons people want to be in Denver. It's like fairyland in the summer, in particular, in the Front Range. Obviously, I don't know what we do in the winter besides skiing and snowboarding and all that. So I'm just bullish on that, and that's I think what it really comes down to at some point for a lot of investors is okay, well call me up in 15 years. See how Denver has appreciated from 2023 to 2038. Now, we'll find out at that point.
Are you an advocate? So what you've also outlined is you're in just one metro market. What do you see as the pros and cons between consolidating all of your rental properties into one metro market versus diversifying across 2, 3, 4 markets?
I believe the advantages are in control. I think that, again, yes, you're taking more concentrated geographic risk in the market, but I think that the advantage, I know the market. I know that this area of town is likely to appreciate rapidly over the next couple of years, and this area isn't going to change much. Or I can make those bets with relative confidence, because I live here. I know the contractors in the network, in my network. I've met the agents that I work with, right? The lenders, all that stuff I think gives you an advantage over time. When things get particularly painful, I can go to the property, see what's going on, and make a call on, okay, this is how I want to handle this negative rehab situation, right? A basement flooded at one of our properties recently. Okay, here's the plan. No, that's not going to that's going to patchwork it. I need to fundamentally solve this problem by doing this, 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 and this. I can see that in Denver in a way that would be much more painful for me to get on a flight and go out of town for. So I always think that despite the differences, regionally, if you're going to look regionally, if you're going to look for an out of town market, pick the best one. Pick the one that you think is going to be most conducive to your goals. But I'd also heavily bias you if you're looking to invest in real estate for the next 20 years, doing it in your backyard might just be the best way to win.
Or at least somewhere that's maybe within driving distance rather than flying distance.
Yeah.
So if you live in New York City, for example, maybe someplace, maybe Albany or Rochester. Right?
And I'm hearing success stories from New Jersey, and pockets there. So again, I'm fairly bullish on the Northeast, and I won't be surprised if New York isn't a particularly good place for the next couple of years as well. So I know it's really expensive, but I'm not a bear on New York real estate here.
Interesting. Yeah, it's hard to squeeze a good cap rate out of New York, or at least out of Manhattan. But
you're going to have lots of rent growth too. So there's lots of good reason to believe in rent growth and lots of cash flow growth.
Right. Now, how do you make projections around rent growth? So this is a topic that's come up. It seems to have come on people's radar fairly recently because for the last decade, we've seen rent growth be 2%, 3% per year. And in the last couple of years, rent growth has exploded nationwide, but property taxes, a lot of that gets offset by higher property taxes because of higher home values. So net to the landlord, it's kind of a wash. How do you price in rent growth when you are forecasting for a rental property?
I think rent growth predictions are all over the place nationwide. I think that there's this really complicated supply and demand dynamic, but then there's also the simple fact that mortgage rates, which is effectively competition to renting, have skyrocketed so much that makes housing so much more expensive and should be significant upward pressure on rents. Here we are in 2023 with, I think, negative rent growth by 1% for the first time in a couple of years. That was a headline recently, year over year again, compared to July 2022. So I think it's anybody's guess. I think you're going to have a lot of downward pressure on rents, though, in my opinion, because of the supply dynamic I just told you about. Again, your competition from multifamily.
Right.
You got the single family stuff coming online, but that's typically owner occupied. All of the multifamily units are rentals, right? So I think that in some markets, you're going to see significant downward pressure on rents. And in some markets, you're going to see rent going up.
The major thing that I'm hearing from you, I think my key takeaway from what we've spoken about so far is that if you're thinking about investing in a market, look at how many new multifamily starts are happening in that market. And that's going to be a key indicator of pressure on price pressure within that market. Would that be accurate to say?
I think that's right. And I think what, kind of listening to myself talk here about the rents and stuff, I'm like, I think the higher level pieces have a long-term outlook. Buy an asset that you're going to hold on to for a long period of time, because this is anybody's guess. And there's going to be volatility in a lot of these regions. It's super complicated. You have to guess at what the Fed's going to do with interest rates. You have to guess at what's going to happen with migration patterns and demand dynamics in your market. You can get a pulse on supply. So that's one thing that you can actually look at. And you're going to have to use that information to make a calculated guess if you want to do like a 3-year investment thesis. If you're doing a 20-year investment thesis, you buy a good property in a good part of town that cash flows from day one, run your numbers really carefully, add value, put it to its highest and best use, and hold on and let the tenants pay off the mortgage and produce a little bit of cash flow. And things are going to be good there. Buy a good deal at a reasonable price, running your numbers. So I think that's the big message. Then again, I of course have spent the last 30 minutes diving into great detail, trying to guess the outcomes of these very specific markets and understand the nuances of what happened last year and try to predict what's going to happen last year. So again, what I'm doing in Denver, I'm holding on to my properties for the next 10 years, right? That was the decision. I might sell them earlier, but I'm mentally prepared to hold on for the next 10 years. I expect them not to appreciate a ton. They may come down in the near term, but at the end of 10 years, I'm going to have amortized the debt to a significant degree, produce some cash flow. And I'm also really liking the bond, or the lending market right now. Because I'm less bullish on things like stocks or real estate. I like the fact that interest rates have risen and I can get a 7, 10, a 12% yield on a hard money loan, for example, or corporate bond debt, for example.
So you're a big fan of private lending right now?
Yes.
Interesting. Can you elaborate a little bit? I'm just kind of personally curious on why you are bullish on the Northeast. The one major factor that I've heard is there's not a lot of new construction happening in the Northeast, which is a reason for bullishness because supply will remain low, which puts upward pressure on prices. Beyond that, are there any other reasons that you're bullish on this region?
I guess, let me rephrase, I'm less bearish. I think I'm more neutral to positive. I think the real estate market's going to be fine. It's not going to explode in the next couple of years, but I think that I think it's going to be, there's a risk of it negatively impacting the South and the Sun Belt. I think that there will be, business as usual in a lot of pockets of the Northeast and the Midwest. And I just think that's because nothing's happening there. They didn't explode in price, a lot of these markets. Again, it's very regional. Northeast is a broad category.
Right.
Tons of places in the Northeast. But you take a town like Rochester, New York, right? Nothing exploded. Nothing came down, with a high interest rate environment. 2022, 2023, the patterns for home price appreciation look almost remarkably, similar to the preceding 10 years, right? So there's a very pretty chart of no change, right? That's comforting in an environment like now, like today's with the higher interest rate environment, compared to a Boise, which is coming down 20%. You're like, what's going to happen there? What's the issue? It's still really expensive out there.
Yeah.
So that's more of my mentality on that. And if I'm looking for a safe haven where you can operate consistently and have good odds at a predictable pattern, I think that there's a lot of markets outside of the really big cities. New York is its own beast, where you can do pretty well and with a consistent approach.
Given how much multifamily inventory is about to come online in the next coming years, new construction necessarily is Class A, right? Everything is Class A when it's first built. So what type of pressure could that put on any multifamily unit, including residential multifamily, duplex, triplex, fourplex, that is Class B or Class C?
So the conventional wisdom is that Class C and Class B get crushed,
right?
In that environment,
right?
Again, third time today, I'm quoting Dave. Dave just did a really good, brilliant piece of analysis here and found that Class A apartment units, existing Class A apartment units, are down 13% year over year on a price per unit basis, in terms of sale price. So right now, and Class B and C down very moderately. So it's really interesting to see that the existing Class A inventory is getting hit first and hardest in this kind of first or second, maybe third inning that were in here of the multifamily game, where a lot of this debt is coming due.
So that goes against the conventional wisdom.
Mm-hmm. I would not have guessed that.
Right. So and just to explain to the audience why the conventional wisdom is the way it is, it's easier to illustrate this concept when we talk about commercial real estate, right? Beautiful, big, gorgeous windows. You can see the New York skyline. You can see the Statue of Liberty. You can see the Hudson River. If you're going to come to work, if you have to commute to work, you would much rather commute to a place like this than you would commute to some dingy little office with ugly office carpeting and fluorescent lighting and low ceilings, right? You would much rather, if you have to commute to work anyway, you would much rather commute to a beautiful office than you would to an ugly office. And so in the commercial space, Class B and Class C is getting absolutely hammered while Class A is doing pretty well. And so just to explain to the audience the reason that conventional wisdom exists, the conventional wisdom is if you build a whole bunch of Class A, people are going to flock to Class A and that's going to hammer Class B and C. So it's interesting to see how that's not happening in residential. It makes sense that if you flood the market with residential Class A, that just means there's more competition. Maybe the demand for Class A is the same, but there's more supply for Class A. You know, whereas with office spaces, it changes the demand appetite, but with residential, the demand appetite doesn't change. So it's simply the supply in each relative class that changes.
Yeah, I have no idea there, and I was surprised by the data. I am in a Class A apartment building as an LP on one of my syndications, so we'll see how that plays out, how that market's affected, but. Yeah.
So anecdotally, syndications seem to have, I'm hearing more about them lately. More people are talking about them. They also seem to be a smoking hot pile of garbage. What is happening in that world right now?
I think a lot of syndicators are in trouble. There's going to be a wake-up call. People are going to lose money. They're going to have it locked up for a very, very long time in a lot of these syndications. And you need to get educated. You need to understand what the pricing is. Then you understand the actual asset class that you're investing in. You need to go through all of the things that I just talked about earlier around supply, theories around demand, right? And you know, how are you going to raise the rents on these properties or increase the net operating income by cutting expenses? And then what's your exit cap going to be? So there's a multifamily property is priced on a cap rate basis. So if it's a 5 cap property is for $100 million, that means it produces $5 million in income.
Right.
If you can increase it to $6 million, now your price goes to 120 million or something like that, right? But if your exit cap is not 5%, but 6%, all of a sudden you didn't create any value by increasing that cash flow from 5 million to $6 million. All that work you did to raise rents, reduce costs. So those are things that you're gonna have to figure out. And I think, this is going to be, the syndication market's going to be an interesting eye opener for a lot of investors.
So why now though? Because I feel like, at least anecdotally, it seems like syndication has gotten worse or riskier in 2023 than it was in the past few years. That's at least the general impression that I've been getting from hearing stories in the battlefield.
Well, okay, so going back to that cap rate dynamic that I was talking about earlier, you're investing in a syndication, and because the competition, lots of LPs wanted great returns. Yeah. Lots of general partners wanted to make the buku dollars that I just told you about, right? Okay, so now that's increasing the price of properties or reducing the cap rate. Yeah. And an interesting phenomena happens, right? If a cap rate is 10, right? So 10%, so $10 million for $100 million, $10 million in profit for $100 million complex. Right. And I increase the profit by $1 million, I've increased the value by $10 million. But if the cap rate is 4%, I have a $4 million, property, and I increase it by, I increase it by, a dollar. That I've increased the value by 20 times or 25 times, right, in a 4% cap rate environment. Right. So as the cap rate gets lower, every dollar of income that you produce generates that much more wealth because the value of the property is increasing by so much more. So it's almost easier and easier and easier and easier to make your financial models explode and the returns explode and produce incredible amounts of wealth in a more expensive commercial real estate market, because if you can drive $1 of income, you're driving $25 of wealth instead of $1 of income in a 10% cap rate environment, creating $10 of wealth.
Right.
So that, I think, fueled a lot of this with that low interest rate environment in particular. And what's changed overnight is that rising interest rate environment. Go from, these low interest rates to a 6, 7, or 8% interest rate environment. Now, all of a sudden, you can't buy a property at 4% cap rate with a 7% or 8% interest debt. Right? You're just negatively arbitraging that. You have to believe that rents are going to explode over the next couple of years for that to make any sense whatsoever. Right? Or that interest rates are going to come cratering back down. And nobody's believing that right now.
Right.
And so that's the problem that people are running into nationwide and in specific sectors one by one. So look, nothing that a lot of syndicators did nothing wrong. Right? Some, the first, the first bricks to fall out or whatever, the first pieces that are crumbling here are the folks that are unethical or were wildly inappropriate and speculative. And there's a couple of news stories around that. But a lot of good, hardworking people who underwrote and tried their best here are still going to lose money or be locked up for a long period of time because of the environment, the dynamic I just talked about.
All right. So let me reflect that back to you. What I heard you say. If you've got a property that has a very low cap rate, let's say you've got let's go lower. Let's say a 3 cap, right? You got a 3 cap and you increase it to a 4 cap. You have just added a third of its value. Is that right?
Sorry, you're not increasing it to a 4 cap. If you take a 3 cap and you add $1 of income to the property, you divide 1 by 3% and you've added what is that, like a property that generates $1 of income at a 4 cap would be a $25 property.
Right.
A property that generates $1 of income at a 3 cap would be a $33 property. So if I increase the value, the dollar from 1, to 2, I've increased the value from 33 to 66 million,
right.
$66, right? In the 4% cap rate environment, if I increase it by $1, I've increased it from 25 to 50. So it just multiplies like that as the cap rates come down. Does that? I know I'm getting really technical here. Hopefully, I'm not losing everyone.
Yeah. And so when you say you add $1 of value to that property, are you talking about forced renovations to the property?
Yeah, you can increase the profit, the net operating income of a property by increasing rents,
or reducing operating expenses.
Yeah, you can charge the tenants utility fees. You can meter every unit. Now the tenant pays utility fees. That reduces your costs.
But when you improve the net operating income, that necessarily improves the cap rate.
The cap rate is so like let's say you're buying a building in New York. It's almost like how much is a
because it's NOI over the value of the property.
That's right. Yes. But the cap rate is kind of like the price. It's not the price. It's not a.
It's the unleveraged dividend yield on the property.
Yes,
right?
And it's a way to compare two properties, right? Two properties.
Exactly. Yeah.
One property might have 400 units, one property might have 300 units, but they'll both trade at a 4 cap in New York for the same with the same set of assumptions.
So, but if you improve the NOI of a property, that necessarily also improves the cap rate of the property. If cap rate is calculated as NOI over value.
Not necessarily. So the cap rate is just what the property trades at. It's a metric of kind of comparing two properties to one another. So they'll both trade at a 4 cap. A 300 unit apartment building and our 400 unit apartment building will both trade at a 4 cap, for example. One will be worth 100 million and the other will be worth 75 million because one is bigger than the other. But the cap rate, you're buying the income. So you're just comparing, they're both worth the same per dollar of income.
So what you're saying, if the formula is NOI over value equals cap, then if you were to hold the cap rate steady and improve the NOI, then the value increases.
Yes. And the lower the cap rate, the higher, bigger the multiplier effect that is. And so that's why people are chasing this down and down and down and down and down and down into the 4s or the 3s. And when you think about that, that's saying, I'm going to spend $100 million to buy a 3% cash flow yield. Right. That's insane. Exactly. When I can go to my bank and get a 4.5% yield. Right. So that's the thing that was happening here is, as things went down, as things became more expensive, ironically, people made more and more money and their financial models had more and more operational leverage. Right. And the returns piled and piled and piled and piled up. And now I think a lot of people rolled into more investments. And that's where I think a lot of LPs are, not feeling so great about certain investments. And again, I'm not even saying that everyone did it wrong. In the low interest rate environment, this was the play. This made all the sense in the world. What's changed is doubling interest rates. And I'm not going to sit here and tell you I would have thought interest rates would be where they're at right now 2 years ago. I don't think anyone would have predicted that.
Right. Interesting. And the model of holding cap rates steady, right? So holding cap rates steady and thereby increasing the value by virtue of improving the NOI, that happens in commercial in a way that it doesn't happen in residential.
Yeah, residential, you compare what's my property worth? Well, my house has 4 bedrooms and 2 baths, and the house next door has 4 bedrooms, 2 baths. Therefore, they're worth about the same amount, about the same condition.
Yeah,
it's a
comparable properties, exactly. Yeah. And even multifamily residential, the cap rates tend to fluctuate. Those aren't held steady, I think, in the same way that they are in commercial real estate. Or major multifamily.
Yeah, I mean, in a small multifamily space, duplex, triplex, quadplex, you're still in the comp basis. But once you get into like the larger multifamily, typically folks are looking for like, okay, what's the best cap rate? And like the cap rate is, it can confuse people with this, but it's really just, I'm going to pay like a higher cap rate. I'm going to ppay less money for a multifamily property that's dilapidated, needs a lot of work and a big rehab than I am for one that's brand spanking new and everything's in great condition. That's fully renovated.
Well, yeah, and that makes sense because you would want returns to be commensurate with risk, and so of course you would demand a higher cap for a dilapidated property because that necessarily is a bit riskier. Yeah, but. Yeah, I think the part of the financial model that's different is the model of holding the cap steady. That doesn't happen in residential.
Well, and the cap does not stay steady, right? That's everyone modeled it like it was going to be. I'm going to buy it at a 4 cap. Yeah. I'm going to raise rent by $1 million. I'm going to sell it at a 5. That's not happening. Not only are rents not going up, right? They're going down this year. Right. But the cap rate is increasing from 4% to 5%. If I have a $5 million an NOI, $100 million property at a 5 cap? Yeah, obviously. If at a 5 cap, and then next year it's a 6. Everything's trading at a 6 cap, but I didn't increase the net operating income. Now all of a sudden that property is worth what, like 20% less?
Less, yeah, significantly less.
18. I think it's 18% less. I don't know that would work, but that's a disaster, right? I mean, you leverage this thing at 30%, $30 million in equity. $70 million in debt to buy a $100 million asset. Now you've got $12 million in equity left. That's an absolute devastating experience. And now you have to wait years to amortize that debt to try to pay everybody off. And I think that's the reality that's happening in the multifamily space right now. I know a lot of people will beat me up and say it's not that bad. It's not happening. But that's what I'm fearing is happening right now. And I think that people just aren't trading because they don't want to realize that loss right now. There's no reason to do it. I've locked in my debt for 5, 7, or 10 years. I'm not going to value my property at $12 million, $18 million lower. No one's forcing me to do that. There's no reason to do it. I'm just going to hold on and wait.
Within real estate asset classes, then, are you relatively more bearish on large multifamily?
Oh yeah, I don't think single family is going anywhere. I don't like what's going to be the shock,
right?
Like everyone's locked in their long term debt. Everyone's got good credit. Nobody's got crazy mortgages. Right. Right.
There's a higher percentage of people who own single family free and clear now than there has been in decades. Yeah. Largely baby boomers, I don't,
I mean, maybe it'll come down. Maybe it'll flatline, but I think there's a reasonable chance it stays pretty flat, maybe even, continues appreciating a few points. I think multifamily is going to have a correction, a pretty big one.
Right. What about residential multi, duplex, triplex, fourplex? Do you think it's going to trend more like single family?
Yeah, I think it's going to mirror more of the single family space. I think it trades on a comp basis for the most part, but it'll be in between. Right. But more leaning towards the single family space. Right. At least I hope, because that's what I own.
How many units do you have?
I have 13 units.
Oh, nice.
So, plus a small piece of a couple hundred units in one of those syndications.
Oh, cool. Very cool. I've got 7. Yeah. Yeah. So this is actually quite validating because what I'm hearing, I've always specialized only in buying residential, and what I'm hearing is residential is the place to be. Residential, either single family or small multifamily, as long as it's classified residential, there seems to be, at least in your opinion, more stability in anything that's classified residential, and perhaps some more risk in anything that would be classified as commercial.
That's right. I waffle between thinking that small multifamily and single family rental real estate is either the best asset to invest in or the least bad asset to invest in. So right. I waffle between those, over with a long time horizon. So my personal view, of course, that, that's like the fox counting the chickens in terms of, promoting real estate. And I work at BiggerPockets.
Right. Yeah, exactly. It's refreshing to hear that when you are bearish on some component of real estate, you are unafraid to express that, Yeah,
I mean, I'm not trying to pump up the real estate market
right.
here. I'm trying to get to the most realistic assessment I can get to.
Right.
And, that sometimes angers some of the syndicators in our platform. And I think there's really good, smart people who disagree with me. So, don't just take my analysis here hard. I could be completely wrong
right.
on all this stuff. This is just what I'm seeing and how I'm feeling about it right now. But yeah, I think that's the deal. And in 2 years, there's a good chance that if any of this comes remotely true, I'm going to be saying now's the time to buy a lot of multifamily because as soon as that construction glut is done with by middle to end of 2024, there's not going to be any new multifamily coming on the market. Nobody's starting a new project at that point in time. So the new supply is going to be much, much lower. It's going to be that boom and bust cycle. So, I'll be back in 2 years telling you how it's time. Yeah.
Excellent. Well, I have not, speaking of time, I have not actually even been tracking the time. This is just flown by, but I assume this is probably around as long as an interview goes. I haven't even been looking at the clock. This is just it's like chatting with an old friend. I mean, it is chatting with an old friend about our favorite topic.
That's right. Thank you so much. Yeah.
Are there any things that I haven't asked you about that you want to cover?
Well, I maybe one last thing to cover would be just kind of practically, what should we be doing right now?
Oh, yeah. All right.
So how does this translate to something like, and so, I think nothing changes about the fundamentals. You earn more than you spend. You accumulate a pile of cash each month, and then you direct it towards an asset that you think is going to be performing over the next 5 to 10 years. Mm-hmm. Real estate's one good option in there. If you have a long time horizon, if you're willing to operate it to some degree, if you're willing to run the numbers in there, I think, index fund investing, always a big fan of that. A big portion of my personal wealth is going to that. And I think that people should weight debt more heavily than they have over the last 10 to 15 years. I think that's one big takeaway here is all this stuff, all this work that's going on, all this analysis, or you can just lend to somebody and let somebody else take the first 30% of the risk on a property. I love real estate, note investing. I love bonds, all that kind of stuff. You're talking about passive income. Simple interest is right there waiting to be collected in this market in a way that I think a lot of people haven't internalized yet. It's so simple. It's so obvious with rising interest rates. Lend. So I would just encourage people to look into that as well, as another part of their portfolio allocation in the current climate.
Right. When you lend privately, do you use a platform or do you tend to do one-on-one deals through your network?
I'm not bold enough yet. I consider myself a complete novice at this. So I actually have networked with a number of hard money lenders. They're on BiggerPockets, for example. And those hard money lenders originate a loan with a lender that they'll know. Right. And then they want to keep originating loans, but maybe they have a $10 million or $20 million pool of capital they can lend. Once they've lent that, they can't do any more loans. So they sell those loans. Wall Street has stopped buying them. So I'm looking around and I just bought a loan from one of my local hard money lenders in Longmont, Colorado. 40-minute drive from where I'm at. Yeah. A property. I called up my friend Mindy Jensen. She told me, oh yeah, if you had to foreclose, this would be a great property to own at this amount, at this price point. So that's how I did it. I called up a hard money lender and bought a loan, did some due diligence on the property and all that kind of stuff. And I did another one out in Washington State as well with another hard money lender. So looking to slowly get into a couple more of those. Fantastic. All right. Well, thank you for spending this time with us. Where can people find? I mean, we've said it a few times. Where can people find you if they want to hear more of you? You can find me at BiggerPockets. I co-host the BiggerPockets Money Show podcast with Minnie Jensen. That's a great way to find me. And my email is scott@biggerpockets.com if you want to beat me up for any of my bad analysis today.